Welcome to Market Overtime. I'm Caroline Woods. AI expansion has certainly played a major role in this year's market rally, but how else is AI adoption being felt across the broader economy? Joining us now, Jessica Inskip, Director of Education and Product at Options Play. Jessica, so good to have you here with us. Thanks so much for being here.
Absolutely. Thank you so much.
So we have so much to get to today, and we have lots of time. We'll talk about your market view, investment opportunities, hopefully being a woman in finance, but I think AI is a great place to start because it remains such a hot topic this year. And when it comes to the AI trade, there's a lot of talk about PE risk in terms of some of those stocks getting a little bit expensive. But you say the PE risk is actually priced to energy risk.
Yeah.
Fill us in.
We got to look at it a different E. Absolutely. So when we're looking at the price to earnings and valuations, we tend to compare it to the dot-com bubble, where there was no clear path to profitability. But now we're looking at hyperscalers. And these hyperscalers have a lot of cash, so they're winning those VC funding. They are clients of each other. All the major hyperscalers, so Microsoft, Amazon, Meta, Apple even, tend to be customers of NVIDIA. So that's all coming together. But what's being promised is taking up a lot of energy, and there is a lot of grid pressure. So the earnings, they seem justified. The price targets keep being raised. They keep beating earnings consistently. It's in the news every single day as it's compounding, and we're seeing more astronomical growth. But what's being missed is this headwind that is a little far away, but it's going to come quicker than we realize, which is grid pressure and earnings pressure.
And what happens when that actually hits?
So we need to think about how that's going to really give us investment opportunities. So if there is a headwind, we need to find a company that's going to make a tailwind. So for example, I saw this really interesting stat where one ChatGPT prompt takes about 15 minutes of a light bulb being on. Think about the energy that is astronomically with all the people who are utilizing it and the mass adoption that is just compounding and increasing ever so much. So for example, NVIDIA's GPUs for Blackwell haven't been released yet, but there is some estimate consensus. It's about 1.8 gigawatts that it's going to require for what is anticipated with those orders they already have all the way to 2027. We only produce 1.2 gigawatts, so that is a 0.6 deficit. And that is a huge issue. So unless there's some transitions on the grid or somebody like nuclear power or anything like that that's going to take these headwinds and turn them into tailwinds, which I imagine there are certainly talks about that, but I want to find those investment opportunities early on because that's certainly going to arise and could be an issue for AI, and we just need to think about the bigger picture here.
So talk to us about some of those investment opportunities then. How do you capitalize on this, pressure on the grid, if you will?
Yeah, so just like when I first was talking on the Schwab Network about AI, did a deep dive on what it takes to create one of those large language models. So it starts with the data sets. Companies need to be in the cloud. So that's why NVIDIA is the first step in Beneficiary. You require those chips in order to make those large language models. So let's apply that same thought process with the energy issue. Copper comes into mind immediately. That's required for this grid issue. And that even surmounts and expands to EV and pressure for this energy transition and even pressure we see on the utilities sector. So copper is required. So mining companies, ETF companies with exposure to copper would be step one. And then there's companies that have more efficiencies. It might take a while to come to market, but like nuclear energy, for example, ETFs that have exposure to that could absolutely provide opportunities as these headwinds start to emerge.
Can you be more specific about some names that you like?
Yeah, let's go through some specific securities. So I've got a good list for you. So FCX, that has copper exposure. BHP, that's a copper mine. So people who are mining those specifically. ETN, that's reshoring, that's coming in. VRT, that's thermal products. So that's when we're thinking about the component that they're putting it together, there's overheating occurring. So we need to consider that as well. So basically, what are these headwinds for AI? What are the emerging in those investment opportunities? And for uranium, a ETF I think would be a good exposure because you're not sure specifically who yet, but URA for uranium.
URA. So when it comes to this headwind though, I'm thinking about EVs. infrastructure has obviously been a headwind, not just in terms of demand for EVs, but also
Sure.
the infrastructure isn't necessarily there for everyone to have an electric
Absolutely.
vehicle. Is that something we have to think about with AI? We just seeing this increased demand on the hardware side for chips. So many companies are talking about AI capabilities, but is there a real risk that we don't have the infrastructure to power all of this?
So we have to think about the grid pressure, but I even think we can expand infrastructure and what that looks like. We're seeing this start out with the phase one or round one winners with the AI narrative, which is the hyperscalers, the big players, NVIDIA, Amazon, Microsoft, maybe Apple, we'll see. But now we're looking at companies that have that B2C exposure. Who has the prime data sets? So we saw some emerge with Adobe, but CRM took a recent hit. And so do companies have, it's not only grid pressure, but it's infrastructure within individual companies that could be a headwind, and it's something understanding, or I'm trying to wrap my head around to find those investment opportunities. Even IBM comes to mind. They have this whole business model. We haven't talked about Watson X and I don't know how long. And now all of a sudden they're taking barriers, they're creating guardrails, they're saying, okay, you have access to your data, let's have some governance guardrails so you're a company and you can implement these type of models. So I really think it's a bigger question than infrastructure for the grid. It's infrastructure for AI altogether, and in what capacity.
Mm-hmm. And we know regulatory issues are another concern, but
They are.
when it comes to the more traditional AI plays, many of the names that you just mentioned, are you concerned that the rally is running out of steam, or is there still room to go for this AI rally?
I still think there's room to go because it's just getting started. And if we think about all of the previous revolutions that were there, they all compound on one another. Meaning we had, I'm going to go way back in time now, Caroline. So we had steam. Think about that. The railways, that was infrastructure that had to be set out. Yes, that took some jobs, but it also created more. And then we moved on to the World Wide Web. No one knew the capacity that the World Wide Web would have. It attacks every single vertical. It doesn't matter where you are, you touch the internet. But at one point, it's like when I first got my air fryer, I didn't understand how it made the chicken that way, but it was. Meaning AI is something that, like the internet and like Steam that was first introduced, that really wasn't understood. So adoption isn't where everyone all of a sudden is using it, but those who are up front are. So it takes time, and I don't think it's run out yet because there's still understanding. There's these new chips, and each iteration is more efficient. That byproduct of efficiency, of course, is grid pressure, but that soon will be overcome because we're in this area of innovation, and I expect that to be applied. Maybe AI will solve the grid problem.
But at the same time, if you think about when the internet was kind of first coming to light, or when we were first starting to search for things, Google wasn't a verb yet, right? So if you invested in Google, you're doing pretty well now. But if you invested in Alta Vista or Lycos or web crawler, some of the very early days of search, you might not be so happy now.
So true.
How do you separate the winners from the losers?
Yeah, that's when traditional fundamental analysis and technical analysis comes into play. It's clear path to profitability. If you are a company that is giving us insight into these new products and there's not real revenue exposure, then that is certainly an issue. Where is that promise of value, and is that promise of value coming to fruition? And then we see that with earnings, and then we can check on the data with the investment thesis, like increases in productivity, to really fit into the overall stock market puzzle. So I think it's different than the dot-com era. So there was a bubble there, and there certainly could be a bubble. I'm not saying that that isn't plausible. However, the companies that are doing well are almost too big to fail. They have the cash. They have become lean and resilient. They've learned from the great financial crisis. They have really... So take, for example, when we went into this first restrictive Fed policy, we were coming out from this area of 0% interest rates. That allowed for astronomical growth, which arguably could have led to some inflation problems that we have right now. But that allowed for companies to invest and to grow post Great Financial Crisis. Once we had this restrictive policy come into play, tech took that hit first, probably because they're capital intensive, if the cost to borrow goes up, greenback and currency conversions, lots of reasons for that. But that gave them a moment to focus on the bottom line of the profit margins. They cut expenses, they became lean, they focused. We're not really talking about the metaverse anymore because Meta started the year of efficiency. And now this new product is coming into a play that has rapid adoption. Now we're focusing on the top end of that. So as long as we're seeing profit margins expand, then I'm okay saying there's room to run.
Okay. So where are you okay continuing to put money to work? Because it's early days of AI, as you said, but some of these companies have seen extraordinary runs really over the past, especially this year. So where would you be comfortable still putting money to work in that space?
Yeah, absolutely. I still like NVIDIA, even though it's gone up so much. I think there is an acceptance if you're an individual investor investing in NVIDIA and realize that when it's up, it's a high beta stock. When it's up, it's up. When it's down, and it could have a 70% drawdown. But you can layer on options and other things to reduce your risk exposure. So I think it's important to be cognizant of risk exposure there. But the hyperscalers I still think have room to run. Microsoft, absolutely, because now we're moving from these individual companies' revenue. We have the chips exposure, but now they have these enterprise vertical solutions. So as long as there's still innovation and we're not banking on the same thing, that would still lead to opportunities for increasing profit margins. And NVIDIA's profit margin is what, 70%? It's ridiculous.
All right, so still very bullish on AI.
I am, yes.
What about, just in the near term, when you think about summer, what about the overall market? Because the whole sell in May, go away adage didn't really ring true last month.
True.
We're now underway in June. What's the summer going to look like for this market?
Yeah, so when I'm thinking about the first of the month or early month coming in, I love to look at seasonality. June is actually surprisingly a really great month, one of the best in a presidential year. So we're there, I think it's up about 75% of the time, which is a very high number. So high probabilities of success, and there's different reasons behind that. From a technical perspective, there are certain factors that I look at to be sustained, like broader participation. If we think about the S&P 500, even though it's bullish on the AI narrative, that is what's holding up the market because the S&P 500 is 30% technology, so we have to pay attention to it. But we do have this shift from goods to services, whole other rabbit hole we can get down if you would like. But nonetheless, I do think we're going to be staying sideways as long as this support is maintained. We've had some some bearish engulfing pattern that happened on May 23rd on the daily chart for the S&P 500. That can be a really bad sign, but we've maintained support, that gap that was below that. So really it's 52.50 I want to make sure is maintained. If it is, then we're set up for a gap up and rally, but I think we need some consolidation prior to that. So I'm actually bullish this summer. But as in jogging in place a little bit higher, which is more sustainable and something I would welcome rather than these ripping rallies.
And then between now and year end, it goes from jogging in place to what?
So this is where it gets a little more tricky because of that presidential year. And traditionally what happens, volatility I think gets a bad reputation because volatility and uncertainty goes hand in hand. We're not certain what the outcome is going to be, so things are sporadic as they're trying to identify and understand price. So when that uncertainty is removed, we could be set up for a rally, meaning president, whomever it may be, that's uncertainty removed in November. However, this really boils down to interest rates and markets go up. There are so many factors that are contributing to a bullish market in the long run, bigger term. Doesn't matter where you land on the political scale. You're a company, you want good revenues. You're an individual investor, you want the market to go up because that helps your 401k. There are so many factors that allude to that. So I think in the bigger picture, always necessarily a bullish market, but it comes down to, is the economy growing? Are earnings still growing? And what does that look like? And it really is the interest rate picture and what the Fed does, because the risk that I see is more tail end of the curve.
Okay, so that's a great segue into asking about your rate outlook, because I think the outlook for interest rate cuts has really shifted a lot since the beginning of the year when we were thinking there could be potentially 6 cuts this year. Now, maybe 1, some are saying none. Does the market need the Fed to start cutting rates this year to sustain the rally?
Well, I think it depends on the reason why the Fed cuts. That's what we have to focus on. Did they cut because they won inflation battle, or is it because they took us into a recession, which their actions tend to do? So depends on the scenario that the rate cut comes in. However, it does create some risk. So what I think we need to consider is the repo market and what's happening within money market stress. Powell gives us some indication, but you have to watch it like a Taylor Swift fan watches Taylor. So you just have to. It's very interesting. We should all get friendship bracelets.
For the repo market.
Yeah, what would Powell do? I don't know. Nonetheless, but to figure out that money market stress. So he alluded to something back in his March meeting in the commentary. Commentary is very important. He told us that a sudden rate, or a spike in unemployment would be reasoning to cut. This growth in GDP is his cushion, and that Q1 taught him to be patient. And I will never forget the words that he stated. When we got the January and February prints that were hotter than anticipated for CPI and PPI, he said, you know what, we had 9 months of really good data back in 2023. He didn't overreact to that. Has high EQ skills, if you will. So he said he's not going to overreact to the 2 months of terrible data. So we didn't see that hike come in, and then the markets automatically react. But then I wanted to understand, well, what is he looking at for credit tightness aside from the other factors that he's talking about? And he mentioned the 2019 and 2020 events that occurred within money market stress. So diving deeper, it's this interest within the treasury market, because we know that the Fed impacts the front end of the curve and those short-term yields. Then there's this trickle-down effect and this balancing act that has to occur because we've got the wealth effect playing where people have savings, but we want them to spend less. So it's certainly more of an art rather than a science, I suppose. But focusing in on the repo market specifically, because of these treasury auctions, we see dealers taking in more inventory. They have to finance that within the repo market. Then we have these quarterly corporate tax payments that are due. The next one's June 17th. So the event that caused repo markets to spike above the high end of that Fed target range was a culmination of that. Dealers having to finance using the repo market in order to take on those treasuries, and money markets being drained because of corporate tax payments that were due. So I'm looking for that event, and then if we notice and watch where the repo rate is and the rates are in comparison to the Fed funds rate or that effective rate, if it's in the higher end of the range, he sees that as tight. So any spike in that, I actually believe, is where a cut will come in.
Okay.
And that's where I'm looking in a little more detail.
So we'll keep an eye on that, but I think that if the Fed cuts because something breaks,
Yes.
because the economic data starts to get weaker, we've
Yes.
seen some signs of cooling, but
Absolutely.
overall it's still a pretty resilient economy. If that happens, then what happens to the market?
Well, you definitely want to be in the market when a cut happens, because it still ends up being a bullish scenario in the long run. And we don't want to time it, we just want to be prepared. That's really what financial literacy is.
How does your strategy change though?
So in this case, I'm a younger investor. So I am always going to focus on the AI narrative and growth portfolios. But for people I talk to who want to have them more income oriented, this is where we adjust accordingly. And that's when options come into play and are really, really helpful for reducing just overall risk exposure. Meaning you may want to start selling covered calls. You may perhaps create some hedging positions at that point, and there's ways to structure that all together. But I do think it depends on a lot of different factors that we'd want to assess at that time. But if there is a sudden spike in unemployment, it's very likely that as soon as the market just hints or feels that a cut's going to come in, a rally will spur, because then we have all these other funds that are on the sidelines, and then this CapEx cycle would kick in, which then is investments that companies will start recognizing revenue, and then we'll be back into rally. So we fall down the stairs. It's going to be quick. It's a buying opportunity when that occurs. We'll get clarity, volatility will be removed, and then we assess the market from there.
In terms of other market catalysts, earnings season over, but came in much better than expected than many were hoping. What's the biggest takeaway from this earnings season? What did you learn?
Yeah, so I think it's important to listen to commentary. What we learned is pricing power is being removed, and I think that's a good sign. It's more insight into the consumer than we've been really getting on this lagged data that we've experienced. Starbucks is cutting prices. Target was having issues. We've heard a lot from the earnings commentary that the consumer is being strained. Even Citi CEO said we see the lower end consumer making more conscious decisions. And that is insight that these prices are coming down, and if goods prices is going to come down even more, then that should translate over into inflation data and hopefully get us more towards that soft landing scenario where the Fed's going to cut because they've won the battle on inflation.
How would you classify the consumer right now? Because for every comment about the consumer being under pressure, there were other retailers that clearly are doing just fine. The Abercrombie and Fitches of the world on sneakers are seeing still strong demand. So the consumer is still spending, maybe just being a bit more choosy. So how would you characterize the consumer right now?
I love this question. We have to categorize the consumer like we would the S&P 500 in a way. Different sectors. There are different cohorts and different age groups. So we do have an aging population. When COVID occurred, the 55 plus left the jobs market. They were retired and now they're spending money, and that's an increase in the services, the sticky inflation that we're looking into. So I think that consumer is very resilient, and there's more of that consumer, and that overtakes it. So therefore, that's extremely important. Then there's this younger generation, talking Gen Z. So I'm skipping millennials and Gen X because we have all the debt. But and that is a strained consumer. But this younger generation, all of them have a high yield savings account. That's a trend. And so there are pockets of the consumer, and it's the majority of the consumer that is resilient. And that could be a major headwind.
So you talk about the younger generation, Gen Z. I think it's important to note you not only have a podcast, you also have quite the following on TikTok. I was watching some of your videos. I'm curious, obviously, I'm assuming you talk quite a bit different in your day job than you do in terms of some of the commentary on TikTok. But what are some of the trends you're seeing on there? What is the most asked question that you're seeing on TikTok, or the stocks that continue to be talked about?
Yeah, so there's popularity with the meme stocks, and that occurs. And I really think it's this interesting phenomena that we weren't ready for. So before I worked at Options Play even, I worked over at Merrill. And we were always preparing for the great wealth transfer, which is something that certainly is occurring, and we're seeing that as we have this aging generation, and that's accumulating. The thought for the preparation was robo-advisors, but it's not what Gen Z wants. And then GameStop happened, COVID happened, and there was this adrenaline rush that occurred, and the meme stock frenzy. Then that graduated to really speculative excess, which is buying options, which very far out of the money option, very difficult to be profitable. That's a big issue. So a lot of people lost money. But then there's this other side, it's two spectrums of investors where they're all about compound interest, buying into the SPY or QQQ, just dollar cost averaging in, which is a great long-term strategy. You should do that for your first 10,000 and then get into stocks. So they want to know, how do I do that? And then what things actually mean. So making, like Abercrombie, just making that generation realize that the stock market is literally around you. And it's very interesting, some of the dynamics that are coming up. There is a thought that if I buy a stock, I'm giving money directly to that company. So it even comes down to the basics, is no, this is a secondary market. Just like I purchase this directly from the retailer is going to get that. But if I were to take this lovely suit and put it on Poshmark or the Real, that's a secondary market, just like the stock market. So it's relating it to those understandable terms that are really helping push the needle, and which my following loves. But it is this balance between how does it actually work versus what questions do we need to be asking. And I find that a little difficult, and it's in paying attention. But I feel like I'm learning a lot because TikTok, we were talking about this earlier, the algorithm serves up content that it thinks you will like, but everyone will like. It's prioritized on engagement and wants you to stay on the platform as much as possible. So if a lot of people like these Abercrombie jeans all of a sudden, and it's the craze and it's selling out, somebody's getting revenue from that. So it's making the younger generation realize you're going to spend money on these jeans. That might be an indication of who's getting that revenue. That's a public company. You can participate in that as well.
Well, you're doing a really great job of helping to connect those dots on TikTok. Just finally, because we're almost out of time, I do want to ask you about being a woman in finance. You've been in for, over 15 years. I'm curious, how has it changed, and what's next for women in the financial world?
So it's certainly more women is helpful. What I've learned, and this is the most funny, embarrassing story, but when I was first on CNBC, sorry for mentioning a competitor there, but all of the titles of the networks were halftime report or 2-minute drill and overtime. And when I was actually naming my podcast, I talked to my husband about it, and I was going through that, and he brought it to my attention that those were all football terms, which I did not put together because it's not my forte. Everyone's different. So the challenge of women in finance, and that I found, is the finance bro, as they like to call it. If you ever talk to one, they love to talk to you about the stock market, but it's representation. When I was first learning about iron condors and gamma squeezes, I was taught about defense and offense and football terminology, and it made it a little more confusing. So what's next is making sure that there are more women showing up like you are today, so we can close that dream gap. There is a really interesting statistics where by the age 7, a female doesn't even consider themselves being president or things like that because there's just not a lot. So representation is important, and I think that's the way that we tackle really any type of problem solving. That's really diversity. It's not difficult. It just means more women making decisions and talking about it, and that's how we move the needle. So.
Yeah, really interesting insights there. I just want to give you a chance for the final word, just in terms of the markets, trends that you're seeing, advice for investors. What's the key point that you really want to home in on?
Yeah, so since the great financial crisis, we have not really cared about the bond market. And markets are shifting, and there's a shifting market dynamic. So it's important to pay attention to the yield curve, understand how it works, look at free cash flow for companies. There was free money, we want to make sure they have cash. So analyzing should adjust for caring for that. Knowing your high yield savings account is variable, and that's not going to be there forever. You could even CD ladder because the front end of the curve is higher, and that's abnormal, and that will certainly change. So it really is financial literacy. Understanding how the market works, that allows you to make supported decisions, and when you are supported and you understand we can't time the markets, but we can certainly be prepared for them.
Do you think the inverted yield curve is still a recession signal?
So I love this question so very much. We have to go into why the yield curve inverts. It creates a credit stress situation. And that credit stress situation has already occurred. We had a couple of bank failures, and the Fed came in with technology improvements and fixed them over a weekend. So it does create credit stress. That has occurred. There are tools now that the Fed has if something were to happen. Before, 0% interest rates are close to. Now we've got a balance sheet that could be added to. Interest rates can be lowered. So if there is a crisis, there are tools, and that inversion leads to credit stress, which has already occurred. So now we just need to see it de-invert from here.
So does that mean a recession's not in the cards?
We wouldn't know yet because it's called in hindsight from the NBER. We might have already been in one and didn't even know it. We did have 2 negative quarters of GDP, and they're called 13 months. So it could be we could have been in one. I don't want to say that we were or were not. They look at it what I like to call 3D: depth, diffusion, and duration. So how deep is the widespread issue? How wide is it, and how long is it? So COVID was very widespread. That's why a recession was called. So it depends on a lot of factors, and it's not just black and white. It's certainly possible.
All right. Well, we were able to touch on so much. Jessica, thank you so much. Really appreciate your insights.
Yeah, thank you for having me today.
Great to have you. That was Jessica Inskip, Director of Education and Product at Options Play. Thank all of you for joining us for Market Overtime. Be sure to download the Schwab Network app and tune in for all of your market news 24/7 at schwabnetwork.com.